Hello, I'm Professor Brian Boucher. Welcome back. Starting with this video, we're going to look at an extended case that will illustrate the accounting cycle. The accounting cycle is all the steps you need to take from recording transactions through preparing financial statements. The case will be about a startup company and will follow it from the initial transactions it makes all the way through its first set of financial statements. The case is going to be spread out over a number of videos interspersed with new topics that we introduce, which we will then illustrate through the case. Hope you enjoy the video. Let's start off with a quick review. We've seen in the last couple videos how journal entries and T accounts are used to track the effects of transactions. We're always making sure that the sum of our debits equal the sum of our credits, because if we do that for every journal entry, we know that the balance sheet equation will hold, that when we add things up, assets will equal liabilities plus stockholders' equity. We saw that debit simply means left side entry, credit simply means right side entry. What we do is we call asset and expense accounts debit balance accounts, so that debits increase assets and expenses and credits decrease them. We saw that liabilities, stockholders' equity, and revenues have credit balances. So credits increase liabilities, stockholders' equity, and revenues, whereas debits decrease them. And through this system, as long as our debits equal our credits, we know that our balance sheet equation will balance.
So, when I buy something at the store, and the cashier says debit or credit, he is really asking left or right.
Please don't say that to a cashier. You're going to get me in trouble. We also talked about one sort of visual way to remind ourselves about these accounts was the Super T account, which views the whole balance sheet as a big T account and helps us show which accounts are increased by debits and which accounts are increased by credits. So now we're going to talk about the accounting cycle, and we're going to go through the entire accounting cycle with an extended case. This case will follow a startup company from their first set of transactions all the way through their first set of financial statements. And that's what the accounting cycle is set up to do. So the first thing that happens is during the period when you're operating, transactions happen. You analyze them using the approach we talked about before. Which accounts are affected? Did they increase or decrease? Do we debit or credit? And then you do journal entries and you post those to T accounts. Once the period is over, we're going to do a trial balance to make sure that we haven't made any math mistakes or transposed any numbers. Then we're going to do something called adjusting entries, which we need to do to get the books correct before we do the financial statements. After another trial balance, we're actually going to put together financial statements. Once we do that, we're going to do something called closing entries, which gets us set to start the new period all over again, over and over and over and over and over again through the whole life of the business. So with the case, we're going to start off with the first part of the accounting cycle where we analyze transactions and then figure out whether to journalize and post them. Journalize is we're going to come up with a journal entry for each transaction, and then we're going to post them to T accounts, which will keep track of the balances in all of the accounts as we go along. So now let's take a look at the Relic spotter case, and let me turn it over to a narrator to give you the facts of the case.
In March 2012, Rebecca Park identified an excellent business opportunity while she was a first-year MBA student at Wharton. She read a story about an MBA student who tripped while jogging in Fairmount Park and found an ancient gold coin in the underbrush. It was an old Viking coin that was appraised at $77,500. She realized that she could set up a profitable business that rented out portable metal detectors to people that wanted to search Fairmount Park for more Viking relics. Also, Park had the idea of stocking her store with sundries, such as water bottles and energy bars, that she could sell at a huge markup to renters before their expedition into the park. Park prepared a business plan and approached a fellow student, Jay Girard, who had a sizable trust fund and who she believed would invest in this new venture. Due to his myriad of other investments and heavy course load, Girard agreed to invest as a silent partner and allow Park to run that business, which she named Relic Spotter Incorporated.
Thank you, Mr. Narrator. Now what we're going to do is go through a bunch of transactions and record journal entries and post to T accounts. After each transaction, You should pause the video if you'd like and try to do the journal entry. Think about what accounts are involved, do they increase or decrease, and then should we debit or credit? And then you can resume the video to see the answer and the explanation. Or if you're still trying to get the hang of it, just roll through the video. You'll get a chance to do some practice on these on the homeworks.
On the 1st of April 2012, Gerard decided to invest $200,000 and Park put up $50,000 to purchase a total of 25,000 shares in the new company. The par value of the shares was $1.
In this transaction, we're receiving $250,000 of cash for issuing equity. Cash is increasing by $250,000. Cash is an asset. We increase assets through debits. So the first part of the journal entry is to debit cash for $250,000. We also have $250,000 increase in contributed capital, which is a stockholder's equity. We increase stockholders' equity with a credit, but remember with par value, we have to split it into two parts. There's a credit to common stock, which is the par value, $1 times the number of shares, 25,000, which is $25,000. The other credit is to additional paid in capital, or APIC, for $225,000. And that's the number that we need so that debits equal credits.
Excuse me, are you allowed to have more than one credit in a journal entry?
The par value again.
Yes, you can have more than one credit and more than one debit. The only requirement is that your debits equal your credits. And it looks like the par value guy is back from the prior video. Yes, we're going to have to deal with par value a lot, so get used to it. And then after we do a journal entry, we need to post these amounts to T accounts so that we can keep a running total of the value of each account. So we create a T account for cash, and we put that $250,000 on the left side, the debit side. We put a little number 1 on there because later on there's going to be tons of transactions in here, and this allows it to trace the amount in the T account back to the original entry. We create a T account for common stock. Of course, this stockholders' equity has a credit balance, and so we move that credit entry, 25,000, onto the right-hand side of common stock, and we do the same thing for additional paid-in capital.
Lacking the funds for her initial investment, Park borrowed the $50,000 from the Imperial Bank of Philadelphia on April 1st, using her parents' house as collateral.
Now, the journal entry for this one, we have to be a little bit careful because the only thing that's going to go in Relic Spotter's financial statements are transactions that are in the name of Relic Spotter. In this transaction, Rebecca Park is borrowing the money on her own account. She's borrowing the money, which she then invests in the company. So we're not going to make any kind of journal entry or T account posting for Relic Spotter because it's not something that's obligation or obligation of the business. It's Rebecca Park's obligation personally. So this is an important concept to keep in mind, is that we have to separate what happens in the business versus what happens with the employees. So there's no journal entry for Relic Spotter here. Rebecca Park would make her own journal entry for her own financial statements, but we don't do anything for the company. Now, having said that, this is the only time in the case I'm going to do this trick. The rest of the case, we're going to have Park does this, Park does that, but from now on, Rebecca Park is always doing things on behalf of Relic Spotter. So you won't see this trick again.
On April 2nd, Park hired a lawyer to have the business incorporated. Because this was a fairly simple organization, the legal fees were only $5,100.
So now let's take a look at the journal entry. I always recommend starting with cash if there's cash involved, because it'll become sort of second nature whether to debit or credit cash based on whether you receive or pay cash. So in this case, we're paying $5,100 of cash for legal fees, which seems quite exorbitant, but yeah, I guess it's lawyers, what can you do? So if we're paying cash, cash is an asset. Assets go down through credits. So we're going to credit cash to reduce the asset, $5,100. Now notice, even though I started with cash and it was a credit, I don't write it first. As we talked about in prior videos, you always want to start with the debits first, credits later, indent the credit, so I left some space for the debit. So now we need to find the debit. So what are we getting for this cash? We're not really getting an asset. This is more just a cost of doing business. So what we're going to debit here is legal fees expense. Remember, expenses get increased through debits because an increase in an expense is a reduction in retained earnings or reduction in stockholders' equity. So the debit to legal fee expense increases expenses, reduces stockholders' equity, $5,100, and our debits equal our credits. So we're good on this one.
Excuse me, why isn't this an asset?
I guess you could say this is an asset because the future benefit is we get to operate the business forever, but that's pretty lame. And in fact, the rules actually say that this kind of expenditure should be expensed immediately as a cost of doing business. Then we need to post this journal entry to T accounts. So we go back to our cash T account. Now we put the 5,100 on the right-hand side, credit side, 5,100, and we label it with a 3. So now you can see we've got 2 entries that have hit the cash account so far. And then we create a T account for legal fee expense and put the 5,100 on the debit or the left-hand side and label it with a 3.
To house the business, Park bought an abandoned pizza parlor near Fairmont Park for $155,000 on April the 7th. The building was old and needed renovation work. The purchase documents allocated $103,000 to the land and $52,000 to the building. Park paid for the building with $31,000 cash and a $124,000 mortgage from the Imperial Bank.
Wow, so this is all one transaction. So this is going to be a big journal entry. Always like to start with cash if we can. So we paid $31,000 of cash. Cash is an asset. Assets go down with a credit. So we're going to credit cash $31,000. Left a lot of space for other things. So what did we acquire in this transaction? We got building and land. Those are both assets. Those are both resources that we can use in the future. As assets, we want to increase them with a debit. So we're going to debit building, $52,000. We're going to debit land, $103,000. Our debits don't equal our credits at this point, so we can't stop. The one piece that we're missing is the mortgage. A mortgage from the bank is a liability. We owe money to the bank. Liabilities have a credit balance, so we increase a credit. We increase a mortgage with a credit. So we're going to credit mortgage payable to increase this liability by $124,000. And now our debits equal our credits, and we finished this transaction.
Why do we need to have separate accounts for land and for buildings? And why don't we record interest payable as well? Won't we have to pay interest on the mortgage?
Huh, those two sort of look like twins. Anyway, both good questions. We keep land and building in separate accounts because when we get to adjusting entries, we'll talk about depreciation, and we'll see that they have to be treated differently. As for the interest question, as of the date we take out the loan, we don't have an interest payable because we don't actually owe any interest. We could pay back the loan immediately without any interest costs. Only as time goes by and we owe money for interest do we actually record an interest payable. So it doesn't show up immediately, only as time passes. We have a lot of posting to do with this one. So again, we have our cash account, and so we have yet another entry in our cash account. This is going to be on the credit side because we credited cash. We create an account for building and land, both assets, so they now have a balance on the debit side or the left-hand side. And a T account for mortgage payable is a credit account. Its balance is on the credit side. So now we've posted all of the entries, all the numbers from this transaction, so we can keep a permanent record in our T accounts.
Park felt that some renovation work would extend the life of the building to 25 years, with an expected salvage value of $10,000. She ordered the renovation work, costing $33,000, to begin immediately. The work was completed on May the 25th, at which time she paid in cash the amount owed for the renovations.
For this transaction, the first thing we're going to do is ignore the 25 years and salvage value sentence at the beginning. We're going to come back to that later in the case, and instead focus on the transaction on May 25th. we paid $33,000 of cash. Cash is an asset. When we pay cash, cash goes down. We make cash go down through a credit. So we have a credit to cash for $33,000. What are we getting for this cash? Well, we're adding to the building. So the balance in the building account has to go up. Building is an asset. We make assets go up through a debit. So we debit building for $33,000.
Excuse me, why isn't this an expense instead of an asset? All of the expenses seem like assets to me, and the assets seem like expenses. Oh, bother.
The general rule is if you spend money on routine maintenance, an expected cost of maintaining the building, then it would be an expense. But if you spend money as a capital improvement, so you've increased the value of the building or how long you can use it, then you get to add it to the balance of the building account, which we do here. But we'll talk about this much more later in the course. Then we post this to T accounts, yet another entry in the cash account, and another entry in the building account, increasing the value of the building.
Park phoned a number of metal detector vendors until she found one that was willing to give her a volume discount. On June the 2nd, Park purchased 240 metal detectors, at an average cost of $500 per unit, $120,000 total. The innovation in the industry is so rapid that Park felt the unit would only last for 2 years, at which time they would have no remaining value.
So in this transaction, we are paying cash again. We're paying $120,000 of cash to buy the metal detectors. Cash is an asset. We make asset go down with a credit, so we credit cash $120,000. What are we getting? We're getting metal detectors. Metal detectors are an asset. Assets go up with a debit, so we want to debit metal detectors for $120,000. And then we're going to ignore the last sentence about only lasting 2 years, no value. We'll come back to that fact later on in the case.
Wait, why aren't the metal detectors considered inventory? Yes, I thought any merchandise that a company purchases is called inventory.
We don't call the metal detectors inventory because we intend to keep them for 2 years and use them over and over again to generate sales, generate rentals. So it's much more like a piece of equipment than inventory. When we say inventory, we usually mean goods that we buy that we intend to sell for a markup as soon as possible. Then we need to post this one to T accounts, so it's another credit to the cash T account, and we create a new T account for metal detectors.
On June the 15th, Park ordered $2,000 of sundries inventory, for instance, water bottles, energy bars, etc., to be delivered on June the 30th. Park was able to purchase the inventory on account, which meant she had up to 30 days after delivery to pay the supplier.
So I like to start with cash, but there's no cash in this transaction. We're receiving inventory, and we owe the supplier money for the inventory, which we have up to 30 days to pay. So I guess a place to start would be that we're receiving $2,000 of inventory. Inventory is an asset. Assets go up through a debit, so we're going to debit inventory $2,000. We owe money to our supplier. That's a liability. Liabilities have credit balances, so we increase liabilities with a credit. So we want to credit accounts payable to increase the liability for $2,000, and we always use the term accounts payable when we owe money to a supplier.
Hey, when is the date for the transaction? June 30th and not June 15th?
Good spotting. On June 15th, we place the order, but there's no transaction. There's no exchange of goods, services, or cash on that date. It's not until June 30th when we actually receive inventory that we then have to account for a transaction. We again post this journal entry to T accounts. We have to create a new account for inventory, which is an asset, accounts payable, which is a liability. We put the debits and credits in their proper places. So we're about halfway done. Why don't we go ahead and wrap up the video here, and we'll do the next 7 transactions in another video. See you next time.
Excuse me, see you next video.